JP Morgan Chase, one of the biggest banks in the world, with assets worth trillions of dollars. But even they are not immune to scandal.
In a highly anticipated investor conference call today, JP Morgan announced the highest legal trading losses in history on its Q2 earnings.
By an emergency
$2 billion. That's how much JP Morgan Chase, the largest bank in the U.S., says it lost over the past 6 weeks.
But what really happened behind the scenes? How did JP Morgan Chase lose billions of dollars in a single trade? In 2011, JP Morgan Chase's London office was making big bets on credit derivatives, a type of financial instrument that allows investors to bet on the likelihood of borrowers defaulting on their debts. One trader, Bruno Ixel, had become so big in the market that he earned the nickname the London Whale. Ixel's bets were so large that they began to distort the market, making it more difficult for other investors to make trades. But for a while, the trades were successful, earning the bank over $2 billion in profits. However, in early 2012, the market turned against Ixel's bets, causing the bank's losses to mount rapidly. The bank's executives, including CEO Jamie Dimon, were aware of the situation and tried to downplay it, saying that it was a tempest in a teapot. But as the losses continued to mount, it became clear that the situation was much more serious than they had anticipated.
We were reducing that hedge, but in hindsight, the new strategy was flawed, complex, poorly reviewed, poorly executed, and poorly monitored. The portfolio has proven to be riskier, more volatile, and less effective as an economic hedge than we thought.
In May 2012, the bank announced that it had lost over $2 billion in the trades, with the losses expected to reach $6 billion or more. The bank's reputation was quickly tarnished, and its executives were called before Congress to explain what had happened. Dimon apologized for the losses and said that the bank was doing everything it could to fix the situation and prevent it from happening again. It soon became clear that the bank had failed to properly manage its risks and had relied too heavily on complex financial models that did not accurately reflect the risks of the trades. The bank was also accused of ignoring warning signs and failing to adequately supervise its traders. The scandal had a significant impact on the bank's reputation and its bottom line, and it resulted in over $900 million in fines and settlements. Several executives lost their jobs, including Ixel, the London Whale himself. In the aftermath of the scandal, JP Morgan Chase took steps to reform its risk management practices and to rebuild its reputation. The bank agreed to pay over $900 million in fines and settlements, and it implemented a number of changes to its risk management procedures, including the creation of a new risk committee and the appointment of additional risk managers. Despite these efforts, however, the London Whale scandal continues to be a cautionary tale for investors and financial institutions. It serves as a reminder of the importance of responsible and ethical behavior in the financial markets, and of the need for proper oversight and regulation to prevent such scandals from happening again in the future. If you enjoyed this video, please give it a thumbs up and consider subscribing to our channel for more informative content like this. Your support helps us to continue creating quality educational material.